Brent crude oil recovers this morning in early trading in Asia and sort of on a doorstep of $120 a barrel again. Let's kick off this morning, or this evening as it is, Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence in East Coast of the United States. Mike, the big bazooka has been fired by Jay Powell and his buddies. Your thoughts this morning? Will it be enough? Does it change the dial? Does it move the needle?
Oh, yes, it's pretty significant. The key thing to think about, when he just went 75 basis points at the beginning of the year, it was predicted they'd go 25 basis points at each meeting. And the key reason they jumped up that was because of this massive rise in energy prices, most notably crude oil. So I think what has happened in the recent one is that the chairman of the Federal Reserve was somewhat baited into going to 75, which means it's pretty extreme. And there's a potential that this could be the last hike, which I know is a bit of an extreme statement. But I think that'll happen most notably if, as chairman says, financial markets continue to tighten for them. And that's what I think is going to be the key thing to look forward, is the stock market's going down. This is actually the midst of one of the greatest reversions in asset prices ever. The top bond ETF in the US, TLT, is down 25%. That's the most ever in its history going back 20 years. I look at the bond future, it's down, it's had the deepest drawdown since 1977. So to me, this is the beginning of the great reversion. We're taking away inflation at the fastest pace I've ever seen it. And crude oil is still sticky at that level, but at some point it's going to collapse. And yes, I've been wrong. I admit that. But to me, it's part of that reason now global GDP is plunging, consumer sentiment is plunging. A lot of that's because of energy prices. And you're seeing that everywhere. So I'll end with this. What I've noticed now is we have this spike up, the highest prices ever in US diesel and US gasoline prices. We're starting to see the rollover in demand. And that's something that is almost a clear indication that inflation's just about ready to peak. And what they just did with 75 basis points might go down in history as the last one.
Let's flip across to Europe and speak with Henning Gloystein, Director, Energy, Climate and Resources at the Eurasia Group. Henning, it seems that we're at an important juncture in the other major global story. We've got the inflation, which Mike just addressed, and we've got the geopolitics. At the center of that geopolitics is the war, Russia's war in Ukraine. We have the three heads of state from Europe heading to Kiev today. What do you read into that? What stage of this conflict, where are we at, so to speak?
Thanks, Sean. So sadly, I mean, the war on the ground in Ukraine seems pretty stuck. Russia has made some obvious gains recently that Ukraine hasn't been able to prevent or push back against. But Russia also hasn't obviously been able to control the entire country as it initially clearly wanted to. So now we're down to sort of signal politics. We've got three heads of government, the big three in the EU, Germany, France, and Italy, on a train to Kiev right now. Very unclear what they're going to do there to make things better on the ground, because, I mean, you know, the EU is not going to sanction gas. The EU's weapons delivery to Ukraine are tepid at best. And actually, there are quiet tones in the EU that want a ceasefire rather than a further escalation of the conflict. So it's very, very unclear what's going on now. And I mean, on to the economics, the EU looks terrible economically, as does the UK, just next to the EU. So the situation in Europe looks a bit sort of murky and misty and not great.
Not Merkel, but murky. Merkel's hangover, perhaps. Henning, is this a train carrying a white flag?
Well, I wouldn't go that far. No, I mean, I don't think they've got a flag. They haven't made up their mind there yet. There is single politics. The EU definitely wants to politically support Ukraine, but the problem is that they're really reluctant to do the really, really hard steps against Russia that would probably make a really big difference, and that would be either or heavy military support and cutting off all oil and gas supplies from Russia. But that economically for Europe is so recessionary that they can't really do that at this stage.
Mike, I just want to pick up on your earlier comments there. I woke up this morning wondering if Powell's move was bearish or bullish for financial assets. I mean, saw the markets take a pop at it. I mean, the idea that the Fed and Powell have been so behind the curve on this thing that they're finally showing some clarity of purpose, that it's given confidence to the equity markets in particular to get back to the races. Your thoughts on that?
That's quite bearish, and he even said it, hinted at it when he points out the market's doing the financial tightening for them. So I think this is one of the biggest the greatest reversion in asset prices since maybe the 29 crash, and we're just in early days. And you're seeing it again this morning. And that's the sentiment that's really shifted from just a few months ago when everybody was buying the dips. Now people get it, you have to sell the rips. And stock market going up is part of the inflation problem. So that's the key thing. I think is going to be the key driver going into the second half. And I fully expect gold might be one of the best performing assets, partly because the stock market should continue to go down. So here we're down 20% on the year in the S&P 500, 30% in the NASDAQ. You take out another 10% in the S&P 500, that may take the Fed out of the picture. But that's the dicey position that we have with energy prices. They are so ready to crack. And as Henning mentioned, there's recession clearly kicking in Europe. It's global. Look what's happened to Chinese GDP. It's beginning year was 5%. Now it's down to 2%. The U.S. is clearly, but it's going lower. But it's not really about recession to me. It's more about reversion and asset prices. They got way too expensive. And then I look over at crude oil and I see it running about 2 times its 200-week moving average. The ability to sustain above that in futures, this is the longest and the steepest and the highest ever. It's been able to sustain that high. So I've been wrong, but it's been one of those things you'd call like a 4th or 5th standard deviation sustainability thing. So I look at it, it's not that complicated. We're just taking back the excesses of excess from the last few years. And the Fed has to continue job avoiding. But I think now what we're looking for is the market's going to do for them. And there's some key indicators that's happening. Look at copper. It's down in the year. Dr. Copper. Lumber was one of the strongest commodities last year. It's down 50% on the year. So to me, it's just about time we're going to hit the crack mode. And it's going to be, I think, second half of this year is going to be very much like the second half of 2008.
Mike, just to pick up on that, I mean, of those sort of reversions, can crude oil be immune to this, at least in 2022? We're seeing it pretty resilient at around the 120 mark, sort of throwing off the sort of weight of this tightening cycle.
Well, it certainly has been, but now it's part of the main driver that the Fed had to raised rates more than expected. How I think it was last week, 6 central banks in the world raised rates. So it's just a part of the example. I think how they call it the higher price cure, but in terms of commodities, they can be their own worst enemies. And that's why, to me, right now, the longer crude oil stays up, the more at-risk assets have to go down. And it's one thing that's not profound to point out is anytime we've had these massive pumps in crude oil historically, it usually dumps afterwards, and most people know it's just a matter of time, because it's its own worst enemy. And you can see that in virtually all the data. Like I just pointed out in just the US, tipping over unleaded gas demand, tipping over diesel demand. And you can just see the spike in prices. The thing is, the velocity of the spike in prices, yes, we have all-time new highs in diesel and gasoline because of the issues with refinery, but that velocity versus its 100-week and 200-week moving average is almost unprecedented. And that's really what things kick in. When markets move too far, the pendulum swings back. And to me, that's what's happening in risk assets. The pendulum's just swinging back, and everybody knows we're way overdue for sharp correction. And commodities, typically, I mean, I just look at what happened in 2008. We've had 250% corrections since then, and we're way overdue for something like that, unfortunately.
Henning, the big question there is obviously is the demand destruction on the weight of this economic outlook. And I wanted you to dust off your old China hat. Obviously, you were in China many years, and your outlook for China in the second half of the year. And we had the geopolitics last night of Xi and Putin back on the phone together, whispering sweet nothings in each other's ear, as well as the outlook for where does China go. COVID stimulus in the second half could be quite bullish for oil.
So yeah, China's outlook, like sadly so many of the things, is pretty uncertain at the moment. But at the moment, most signals we see from China economically are weak. They are going in and out, and mostly in to new COVID restrictions. Beijing, Shanghai, they ease restrictions, and then 2 days later they put something back in. So that's causing all sorts of domestic and international economic issues. And their stimulus program is expected, but it's expected to be nowhere near as strong as it was over the last couple of years. So I wouldn't put too much hope into like the big bazooka stimulus as has been in the past. And politically, China obviously can't come out in support of the United States or Europe over Russia, but they're clearly unhappy with what's going on there, because this war has caused huge problems for China as well, because all the energy and raw material space is in huge distress because of this, and costs are inflated not for positive reasons, i.e. strong demand, but for wrong reasons because of dislocated and disrupted energy and raw material supply chains, including food. So China is not happy about what's going on in Ukraine. And I suspect actually in that little quiet talk that China told Russia about its opinion on this. But again, they can't come out in support of the West over this. They probably want a sort of a quiet solution that is a bit dirty but calms global markets. But economically, I don't think China is going to be a particularly strong story this year. The risk is much more to the downside there, actually. And so I actually agree with Mike. There is a bit of a risk that, yes, oil price might spike again because of the war in Ukraine, but the demand destruction, the risk of demand destruction looks pretty serious now, and that would come from a recession potentially.
Well, Henning, with that outlook for China, what does that, or how could that impact the coronation of Xi into his sort of king for life at the end of this year? Going into that, that's a lot of weak signals. Your thoughts on the dynamics around that?
Yeah. So despite all the problems that we've outlined around China this year, we don't really think Eurasia Group that there's any risk to Xi's next and eternal term, but barring a major catastrophe. I mean, things happen that no one expected. So sadly, this year has been one of those. But no, I mean, we think Xi Jinping will stay in power in China for the foreseeable future.
What about on that messaging, just to understand a little bit about the granular structure of China's obviously massive country, massive population, governors and governance, different regions, the messaging of they've signaled in recent days this idea of maintain the COVID lockdown policy, but we also have to have an economic lifeline. And the messaging of that down to the regional governors and mayors and whoever implements these policies on the ground looks to be a little bit disjointed. Your insights from exposure there to how the mechanics of that would work?
It's really messy. Well, yeah, I think it's the latter, but it's really messy because there's mixed messaging coming from Beijing about lockdown, not lockdown, what to do, and in the end, they're pushing the envelope to the regional authorities, and if something goes wrong, they'll make them pay for it, and if everything goes right, they'll take the credit in Beijing. The problem in China is a little bit regarding COVID. China's told the world and its own population for the last 2 and a bit years that China's the only country that's been successful with zero COVID, so they can't now just let rip and say, okay, that was nice, and now everyone gets COVID. The next thing is there's some Chinese reluctancy to vaccine hesitancy, especially in the elderly population. And of course, elderly people are the most exposed to COVID. So they're really worried about a deadly outbreak within the elderly unvaccinated population. And then the Chinese authorities have told the world and its own population that Chinese vaccines are better than the rest of the world's, and that we've known from studies in the field now that that's not really the case. They're not using mRNA vaccines, which have shown a strong efficiency, efficacy against severe illness, and all that combination puts Beijing in a really complicated position here. They can't really give or commit and say like, "Oh, sorry, we weren't right about this last 2.5 years," and that makes it hard for China at the moment.
Mike, I just want to talk a little bit about the U.S. politics of all of this. The demand destruction doesn't look like it'll come in time to lower energy prices for Biden and the Democrats in the midterm elections. We've had primary results in the last few days in the U.S. What is the Fed bazooka and energy prices look like for the political outlook this year?
Anybody, all the incumbents are toast. It's just that simple. When you have the strongest inflation in 40 years and the weakest consumer sentiment in our database since 1950, which printed last week, they just take out the incumbents. It's simply the way it works. And so it's probably going to be a one-term president. I mean, it's only 2 years from there, but the midterms are just, going to go back to the drill at will world in this country. And that's the key thing I think that Henning pointed out, is that juxtaposition that's really the problem in China. Everything's declining because of the autocratic rule, and you can't get rid of the leadership, which is messing everything up. It's that simple. And this country, yes, very imperfect, but we take him out. He's gone. Whatever leader doesn't work, after 4 years, they're gone. And that's clearly going to happen. And we're going to swing the pendulum. It always swings, but this time it's going to swing so extreme. So I think what you're going to see is more bias towards, instead of old Democrats, younger Republicans.
Just on that point, is there a chance Biden doesn't run, and that after the midterms, he sort of steps back and says, I was always just a transition guy?
Well, I don't know how he's going to say it, but there's a good chance he's not going to run. He might do a President Johnson. But it's clearly the signs that there's virtually no chance now, if there's election for presidency, he would not be elected. It obviously depends on the alternative candidate, but right now for the midterms, anybody who's an incumbent is toast, most notably the Democrats. This whole vision of green energy and everything, forget it. We want to attack inflation. And the key thing, it's going to happen organically anyhow. I view what this just happened now. We've had this, turned out inflation wasn't transitory, but what I see is going to be the deflation is not going to be transitory. When we go back to this normalization, what commodities always do and what markets always do, and I think we're heading towards a period where it's going to be like post-1929, but with a little bit different world. And that's the key thing you have to think about with risk assets now. The Fed is going to be so reluctant to ease because of what happened when they eased too much, that we're going to have a period now in terms of risk assets are going to be down and should have a period of underperformance for a very long time. Commodities are part of that. Crude oil is part of that. And copper is part of that. And from a commodity standpoint, that's why I look at this as, yeah, good luck. I just have seen these before. We've all looked at the risk, but the market looks to me like it did in 1980. Commodities went down and stayed down for 23 years. In 2008, went down 50% twice. And then it took until this year to take out that old high.
If we look at, Mike, the other comments overnight out of the US by the White House press secretary indicating that Biden, I mean, we talked about the demand destruction, what it looks like unlikely to come quickly as a rescue for Biden, but supply, they've done the SPR, they're jawboning suppliers, and now the idea of the Defense Production Act actually mandated by law to force US oil producers to increase and refiners to increase capacity. Your thoughts on that sort of stick, so to speak?
Well, let free markets reign, and that's unfortunate. They've been so restrictive to free markets. And just what Biden said the other day about Exxon making more money than God, I'm like, that's just part of capitalism, and that's part of the boom and bust cycles of energy. I mean, Exxon and most energy producers got hammered the last 5 years, so it's coming back. But I think the key thing to point out is what just happened 2 days ago when we saw that U.S. natural gas drop 15% in one day because of one major L&D exporter who had a problem. People realized the big problem with all energy is massive, excessive North American supply, at least right now. It's going to come back. It is coming back. And when that natural gas went out, people realized, okay, the U.S. cannot export enough natural gas to keep prices buoyed. And right now, the prices still have to peak in 2005 for a reason, because that supply is coming back. And if you really think about Defense Production Act, there's an ocean of natural gas under the state of New York, and it's still not being exploited.
Let's go to the survey question and give everybody else a chance to comment on this thesis of oil prices will remain immune to accelerated Fed tightening cycle for the remainder of 22. After that, the world may come down and finally the weight presses oil downward. But the question is really for this year, is this Fed tightening cycle? We're already trading August contracts and so forth. So the question, oil prices will remain immune to accelerated Fed tightening cycle for remainder of 2022. Agree or disagree on that point? Henning, we've talked a little bit about the big meeting in Kiev today, and it's quite intriguing to me that we could be at a juncture in this conflict, because we're either going to escalation vis-a-vis the Russians taking not only the Donbass but then across to to the whole of the Black Sea coast and on to perhaps Moldova. But the other meeting that has become confirmed overnight is the Saudi-US Biden MBS meeting in the Middle East. What that looks like, what are the sort of contagion for that? What's Eurasia's outlook for that?
Yeah, it's amazing. I mean, so this year, because the situation in Ukraine and the war that Russia's caused there, first then the US wanted to de-escalate the Iran situation, find a deal to lift sanctions. It hasn't worked. Now Mohammed bin Salman and Biden will meet in July. The US desperately wants Saudi to produce more oil. Saudi is really not that keen to just be the savior and just pump everything out in a situation where markets are tanking. There's a recession risk, and let's not forget OPEC actually sees this as a massive dislocation and price surge because of Western sanctions, not because of an outright disruption to physical crude oil supply. So they're really reluctant. And also, it's also possible that OPEC, and including Saudi Arabia, doesn't really have that much spare capacity to pump that much more oil. So it's, I mean, look, it's good that they're talking. I think in a situation now where there's a major war in Europe and every supply chain is stressed, including oil markets, it's good that they're talking. It's good that they're meeting. That's compromise and dialogue is a good idea at the moment, I think. But I wouldn't put too much hope into it. Say in that some people seem to think that once they meet, the Saudis are going to open the taps and oil prices will be wonderfully modest again.
No, you wonder about. I mean, I think in some ways the oil piece is the least of the interesting things. What of all the other things that could be the dots connecting here? But Henning, I wanted to get your update on the other big narrative that has come with all of this is energy security versus energy transition, and there's there's a lot of engagement in the region here. We got an accelerated LNG plant commissioned in Fujairah. Obviously, the Qataris are looking to bring more gas to Europe. Where is the Europe's compromise on energy transition in order to build this big boat called energy security, or where do you see those two things at this point?
So it's actually fairly clear now what's happening in Europe. One of the few things that aren't that uncertain is in the short term, the Europeans are doing absolutely everything to ensure supply, even if Russian oil, especially gas and coal, were to stop to flow to Europe. And that means demothballing every coal-fired power station, importing as much energy as they can, and just accessing any source of energy that they can in the next 1 to 3 years.
But not sustaining nuclear power plants in Germany. It seems they're going to proceed with closing those three that are the remaining three.
Those remaining three, the German government wants to still close down, but if push comes to shove next winter and it's either outages or let those three run a little bit longer, they'll do the latter. But that's only 3 reactors. On the global, on the European scale, that isn't really that relevant. Long term, however, it is absolutely clear now. Every major EU and the UK government have now said they will double down on the green transition. They're going to throw money at it. It looks slightly different in every country, but the green transition is going to accelerate because of this, because the signaling is really clear. If you are exposed to a high risk of import disruption of fossil fuels and energy prices are going through the roof because of fossil fuels, the signal is clear: invest into local, clean, domestic production, and that is what the EU governments in Brussels and the UK will be doing, at the cost of short-term increase in consuming absolutely everything that's non-Russian.
Which is, it sounds, Mike, the opposite in the US. It's back to black.
Well, I think what Henning described is what we're going to look back from history as the great paradigm shift in accelerating the process that was pre-existing before the war, and that is shifting towards renewable sources, green sources. And the key fact is, you look at the world's largest demand pull source for imports of crude oil, just the last 100 years or maybe 50 years, has shifted to net exporter. The U.S. consumption of liquid fuels is actually starting to decline the last few years. And this is accelerated now on a global scale. So I think, and also now we've had this major dichotomy in the world now with Russia, China versus everybody else. I mean, you saw it in the UN when 80% of the countries voted to condemn the invasion. And Henning, I think, described what's happening is they're living in the 20th century and the rest of the world is accelerating into the 21st century in terms of commodities. This is not good from overall demand for fossil fuels. So I like to say is you don't want to be long anything you can grow. In this country, you can grow a lot of petroleum, biofuels. You want to be long things that you can't grow, like metals. And the fact that copper is going down in that environment, we're only going to have the decarbonization, electrification, create a lot of demand for all the metals, is a sign that, okay, in the shorter term, we're going to have a pretty severe recession. Risk assets going to go down hard, most notably the stock market. But in the longer term, you want to be looking at things like metals and gold and Bitcoin and long bonds. I think are going to be some of the top investments to start performing in the second half of this year. But for commodities, most notably fossil fuels, this ain't good.
Mike, just to close out with, I wanted to get your thoughts on the latest sort of victim. I mean, we're all sort of sailing blind, it seems, in this new world in terms of the reference points that give signals to what might be coming. Fed forward guidance was the sort of gold standard, at least in recent years, as to where the world was moving, where Fed and the cost of money ultimately were moving. The Fed shocked the market yesterday, although in recent days it was signaling it quite hard. Have we now lost Fed forward guidance?
No, there's a key thing I watch for a key guidance for the Fed, and that's the one-year curve in Fed fund futures. I actually used to trade in that pit, and right now it's exactly at 214 basis points. That means a year from now, it's a rolling spread. The market expects the Fed to raise 214 basis points. I think that spread's going to be wrong. I think what's going to happen is they're not going to raise that much. This is typically what happens when the market the pendulum swings too far and the Fed doesn't raise that much. That's where the opportunities come in. And the key thing to stop that from happening is the stock market continuing to go down. Now, crude oil going up is making the stock going down. That's kind of the juxtaposition. So that's the one to watch. And that's where I think when that happens, when we see that Fed rate hike expectations start coming back, which is my expectations, because stock market going down, then the assets to buy will be things like gold, U.S. long bonds, and eventually the high beta one, Bitcoin.
Well, let's wrap it up there. Let's get the survey result and call it a day, call it a week here in the Middle East. The survey result, oil prices will remain immune to accelerated Fed tightening cycle this year. Agree 2-1 seems to be the view of this room. It's certainly, and with Brent now trading this morning at 119.45, back to that 120 handle, and trading forward into August and September at 115 or in and around that. It seems that at least for this year, bionic revenues for all those who sell oil every day. Mike McGlone, thank you so much. Really appreciate it. I know you're up late, but really thankful for that. Henning Gloystein as well from Eurasia Group in Europe. Thank you, Henning, so much. Have a great weekend, everybody. We'll be back here Sunday morning, 10:30 UAE time for Week in Review. All the best.
Thank you.